and welcome you so just a little word about our Chamber of Commerce. We are here in Tampa and we serve all the West Coast, and we help business owners to grow their business in the area, French business owners and American business owners who want to also work with French speaking. So today, I invite you to go on our website. It's framco.org, framco.org, to if you don't receive it, to sign up for a newsletter, because every month we have always new networking webinar, happy hour, a lot of events to educate also our business owners here in the area. So today, I'm very thrilled and happy to welcome our speaker and presenter. His name is Sebastien Gilles. He's from France and in Florida since 2019. He's a financial advisor with Florida Financial Advisors, and he is going to talk about wealth management. And a lot of people from France don't know, because this is specific in America, how to invest and to grow their wealth. So thank you, Sebastien, to be here with us, and welcome.
Merci, Betty. Thank you for the introduction. So let me go ahead and share my screen. Can you guys see my screen? Okay. Perfect.
Yeah.
So nice to meet you, everybody. Really excited for this opportunity. So quick introduction about myself. So I'm originally from France. I grew up in Saint-Étienne, and I did my studies in the north of France at the EDEC Business School, where I got a double master's degree, studied my career in consulting in Paris, and then, as Betty mentioned, I moved to the US in 2019, mostly helping entrepreneurs and early stage companies raising money. And then since 2022, I now work for Florida Financial Advisors, so mostly helping individuals and business owners about their personal finance. So very excited to share with you today some of the strategies that we use. So a lot of things to cover for the agenda. So we'll see if we have time to cover everything. But doing a quick introduction about Florida Financial Advisors. Why are we different? What typically do we do? Then cash flow strategies and tax planning. That's usually a pretty big piece of the financial picture, looking how we can maximize the savings, for example, how to invest the most tax efficiently as possible. Touching on some business owner strategies as well. There's a lot of ways you can save on taxes and improve returns for business owners. Looking at education planning as well. The system is very different in the US than in France, so planning early is very important because education tends to be very, very expensive in the US. Retirement planning, same thing, sharing some strategies and touch upon the investments, because I know the markets have been pretty crazy lately. And then we'll leave some time for the Q&A session, or if you guys have any questions, you can put it in the chat and we'll cover that later. But first of all, so Florida Financial Advisors, as I mentioned, I'm a district manager. I'm based in Tampa. I'm a licensed fiduciary. If you're not familiar with the term, that means I'm legally tied to the best interest of my clients. So that's very important when you meet with financial advisors. What's important with Florida Financial and what we do is that we are comprehensive financial advisor. That means we look at everything under the financial sun. So for example, from a personal standpoint, looking at how we can look at the different goals that you have and plan for those goals, whether it's saving for education, whether it's planning for retirement, whether it's looking at disability, life insurance, long-term care, any type of, on your personal level, on what we can help. Then from a professional standpoint, so most of the folks in the US save, for example, in 401ks. So 401ks, there are different ways you can invest inside of it. So getting better rates of returns is important because you savings over time make a big difference. Some folks also get some stock options, restricted stock units. So how to maximize those returns is really important as well. And then, of course, on the financial piece, how we can maximize returns. I work with different portfolio managers, so we do manage money as well. We're just not a bank, so if I do manage money, I use either Fidelity or Charles Schwab as a custodian. But that's pretty much about us and Florida Financial. We're also independent. That means if I recommend any products, any type of investments, mutual funds, I'm not incentivized to go with one company or another. So I can recommend Vanguard Mutual Fund, Fidelity Mutual Fund. So that's pretty much it for Florida Financial. We service about 4,000 households in the US. We have about 30 different offices. I personally service about 80 households and mostly all across the US and mostly working for French companies and defense space as well. So the first piece to touch upon in the financial planning process. So when we look at financial planning in general, there are two phases. First one being this accumulation phase. So you're currently working, you're accumulating assets, you're getting promoted, getting raised, any things of that nature. Then comes the distribution phase. So distribution phase, that's when you're ready to retire. For example, you can be at any point in time on that scheme, on that timeline, sorry. For example, if you want to retire at 67, then it's a different piece that we need to look at. For example, how to mitigate taxes, maybe taking less risk. But what's really important in this accumulation phase, the first piece is the cash flow, how to allocate the most efficiently our assets. Second piece is the taxes. And the last one is the investments. So we'll touch on all of those, starting with the cash flow. So very basic strategy when we look at cash flow. It starts by setting up a budget. Whether it's you at home or your business, you need to think of yourself as having, for example, financial projections. And a good rule is to save about 10% of your income. That's the example, for example, of Shane and Sean. So they both make 4,000 a month. Each of them have different expenses. So what I work with my client, I either use an Excel sheet that we update every quarter during our meeting, or if you want to be even more detailed, you can use, for example, different apps like Rocket Money is a pretty good one. The idea is that allocating at least 10%, for example, for Sean, he's allocating 10%, so that's about 500 of his income that he's saving versus Shane doesn't save anything. 40 years later, assuming a 10% rate of return, Sean will have about 2.7 million. So when he's ready to retire, that makes a big difference to have a budget and at least savings allocated. Then when it comes to savings, the question is, why are we saving? So there are two ways. And what's really important to know when you're saving is to look at the what we call the time horizon. For example, so some goals that you might have, for example, buying a car, buying a house, going on vacation, planning for a wedding, those are short-term goals. For example, within 1 to 3 years, you expect on using that money. For that specific type of savings, you want to be conservative. Simply because, for example, let's say if you invest everything in the stock market drops 10%, then you're missing out. That might not be the same vacation, for example, that you planned for, not the same car. So a good option are, for example, high yield savings account or money market fund. Mostly you get 4% as a rate of return on your money, and it's really not risky. If we think more long term, though, 4-year plus, that's identifying, for example, retirement. What does that look like? And then kids' education as well. Then this is an early retirement as well, something we got to plan for, and mostly long-term wealth. So passing on money for these specific goals, it's better to invest in stocks, bonds, index funds, anything that will have a better rate of return over time, because then the difference between the two. would be the example of Kelsey and Kayla. Kelsey is saving about $500 a month, but into a high yield savings that's paying her 2%. 40 years later, she has $365,000 versus Kayla. She invests everything in the S&P, in the stock markets, earning 10%, similar to Sean. She gets 2.7 million. So that's the importance of compound interest and earning interest over time. That makes a big difference. So now that we know that it's important to save and why we should save, the question is, how do we save? So from a tax perspective, there are 3 ways you can save from a tax perspective in the US. And to illustrate it, it's visually, it's good to see a tax triangle to illustrate it, but I like to see it as a stool. It's like a 3-legged stool, so we want it to be as balanced as possible. The first bucket that most folks are familiar with is this after tax always, ATTA. That means you are currently contributing to this account after you pay your taxes. So you get your paycheck, you pay taxes on it, then you put money to your checking, savings, CD, or brokerage account. This is a great bucket for liquidity, meaning the money that you have access to it immediately. But the issue is that you pay taxes at the entrance, and then you're going to pay taxes on the capital gains as well as on the dividends that you get. So it's a good bucket for liquidity, but you get taxed up to 3 times. So you're pretty much Uncle Sam's best friend at that point. The second bucket that most folks use is the pre-tax tax later. So with this bucket, you contribute before you pay your taxes. So that's the example of a 401k or traditional IRA. How does that work? For example, if you make $100,000, you contribute to this bucket, $10,000 annually. Now you're only showing the IRS that you actually make $90,000 a year, and you get taxed on the $90,000. But so that's a good bucket because you're saving on taxes today, but the tax later, you will have to pay taxes later at ordinary income. So depending on the tax bracket that you're in, you have to pay taxes, and most of this money, for example, 401k, an IRA, Social Security, you have to wait a certain age, which for the 401k, the IRA, that's 59 and a half before you can withdraw that money. Then the last bucket, sometimes folks forget about it, is the after-tax tax never. So same thing as our first bucket, we contribute after we pay our taxes, but any growth on the account, you don't pay any taxes. So for example, if you think that you're just having a child or your child is 2 years, 4 years old, there's a lot of time that you have on your hand to invest for his or her college education. So that could be like a Roth option. Could be a Roth IRA 529 that's specific to kids' education, municipal bonds, or SDLI that's specifically designed life insurance. So it's for example whole life or universal life policies. You can invest in an insurance product, building cash value, and then take tax-free distributions from it. The idea is that if you're saving for your child, for example, a 529, you can accumulate 150,000 maybe, not paying taxes on that money versus paying capital gains, 15% plus dividends. That's a big difference. That's 20,000 that you're giving away. So that depends on your goal. From a retirement plan perspective, that's also important to diversify because in the scenario that, for example, let's say you plan on living off 100,000 in retirement. So if you plan on spending that would be about 8,000 a month. If you don't diversify the way you save, most likely you will withdraw to pay for your living expenses, maybe 50 from this bucket, 50 from this one. So overall, you're withdrawing from taxable assets. So to get the 100,000, you probably have to withdraw maybe 125 and pay the taxes on it. So you pay about 25,000 each and every single year in retirement. Starting to diversify the way you contribute, maybe we can withdraw 40 from a bucket that's not taxable. And now we only have 60 to pull from a taxable account. that's putting us into a lower tax bracket. So maybe we only withdraw 70. So each and every single year, we just pay 10,000. So that could be the difference of 15,000 that you save each and every single year in retirement, and at least keeping Uncle Sam's out of your pockets. But that's pretty much it for tax diversification. So important to diversify depending on the situation. That could be a different scenario, but there are a lot of options out there. Next section is around the business owners saving strategies. So 3 different sections for this one. The first piece being the tax write-off. So whether you are a business owners, for example, having an LLC, C Corp, S Corp, or even being a 1099, it's important to discuss with a CPA or an accountant and see how much money you can save by writing off as many items as you can. So those are just example, for example, like office expenses, payroll expenses, home office. You can take a home office deduction if you work from home, advertising, promotions. That's for generic tax write-off. In terms of the structure of the business as well, that's important to consider. So there's different structures in the US. A C Corp is one of them. LLC is the most common one, the most famous one. It's similar to a SARL in France, or an S Corp as well. So an LLC, the advantage of having an S Corp versus an LLC is that you can actually write off your salary. And by doing so, you are reducing the self-employment tax. So how it works, let's say you are making 150,000 profit on your LLC. This entire amount would be subject to self-employment and payroll taxes, which is 15.3%. So in total tax, this is what you would pay. And then on top of that, this is added to your taxable personal income. But with the S Corp, you are only paying the self-employment and payroll taxes on the salary that you pay yourself. So for example, owner wages, if you give yourself a salary of 50,000, this is the one that's subject to the 15.3%. So then you reduce your taxes by about 15,000 in that scenario. And then, an S Corp, it's just a way of filing for, it's a tax classification as a business, but mostly you still declare 150,000 that you'll have to pay in federal taxes, but at least you minimize the self-employment and payroll taxes. The other advantage of having an S Corp, but that's also the case with an LLC, is to create benefits for yourself. So creating benefits, there's a ton of different options. The idea is that if your business is generating a lot of extra cash flow, you don't want to show the IRS, for example, my business is generating 400,000 net income, because you might not need that money for your personal living expenses or for the business. So what you can do is to defer some of that money by setting up, for example, if you have an employee, you can set up 401ks. If you're the only person inside of your LLC, you can set up what's called also a solo 401k, or a SEP IRA, SEP IRA. The idea is that instead of having this, so there's limitations in terms of how much you can put into it. For example, for 401k, that's 69,000 total. So coming back to the example, if you generate 400,000 net income, now you can show that I'm actually not making 400,000 because 69,000 of it goes tax deferred into a 401k. So now you only owe taxes on about, that would be 331. So depending on your case, if you have a lot of extra cash through your business, you can pay yourself differently by at least deferring some of the taxes. Defined benefit plan is also a good option because you can defer more money. It takes time to set up, but depending on how many employees you have, your structure, there's a lot of things you can do as a business owner. Then the next section, so around education planning. As I mentioned, education planning tend to be really expensive in the US, so it's important to plan early. in terms of numbers, so when we look at inflation, we have a lot of people talking about inflation. The generic inflation rate is 2.5% each year. For education and college in the US, that's about 6%. Meaning if you have a child, for example, that's 2 years old and you plan on paying for all education and housing for a public school, you have to plan on having 218,000. So that would be 16 years from now. Simply because inflation gets so high that, and it's even higher if it's out of state and private, for example. So having a plan in place, knowing how much we need to save each month and towards what different funds is really important if you plan on paying for all of the education of your child. Otherwise, you can also have them having a loan. But then the question is, how do we save? So there are different ways you can save. What most folks are doing is to save simply in cash and savings. But as I mentioned with the tax triangle, not the most tax efficiently way to save, because you're going to pay dividends and capital gains tax. 529 is also a good option, as I mentioned. The money will grow tax-free only if it's used for qualified expenses. So, for example, tuition, any books, any things of that nature. Anything outside of that, for example, if you want to buy a car for your child when they go to college, this will not work in the 529. So looking at other options, taxable investments, or even, as I mentioned, insurance with cash value, or even a minor account is a good option. So depending on your situation, how much you want to save for your child, there's a lot of things we can look at for education planning. Then the next section, so retirement planning. Retirement planning is a big topic, but to make it pretty quick to talk about it, first step into considering retirement, make sure we're on track, is to think about the income gap. So it's a very basic formula. We take into account the living expenses, meaning how much do you want to spend in retirement. So just for the example, that could be 100,000 that you spend in retirement annually, so 8,000 monthly. Then looking at the other side, we look at the fixed income. So that could be Social Security, that could be a pension. I know some folks have Social Security from Europe, Social Security from the US. Any type of annuities as well can give you a source of income. So you can probably have maybe like 5,000 a month. That would give you about 60 in terms of fixed income. Then you identify your income gap. So in that case, that would be about 40,000. When we know we have an income gap, there are different strategies. One of the most basic one is simply withdrawing from our assets. And a good rule in finance, I don't know if you guys heard it before, is called the 4% rule. What the 4% rule is telling us that if we withdraw 4%, so that's the line that's orange, if we withdraw 4% or less of our assets each year, historically, this is based on historical returns, our portfolio will keep going up. If we withdraw more, for example, 5%, 6%, 7, 8, at some point, we will run out of money. So if you want to know if you're on track based on your income gap to retire, a good rule is to consider what could be 4% of the assets that you have accumulated. So in that specific scenario, 40,000, if that's your income gap, that means to be able to retire, you need to have accumulated 1 million and you'll be okay. But then inflation comes in play as well. Healthcare expenses are also very expensive in the US. So one of the other strategies that we use for retirement planning is called the 3-bucket approach. The idea is to divide and separate your assets between 3 different buckets. The first one, protected growth. The idea is to cover our living expenses and solve for that income gap that I mentioned. So for example, there are some investments out there like an annuity, similar to a pension, that could guarantee you a withdrawal of 6-7%, so way higher than the 4% rule. Then once the living expenses are covered, another bucket to take into consideration is to have money liquid. So that's, for example, the cash, the savings. The idea with that is we have our living expenses that are covered. Now let's take into account, what if an emergency happened? So what if you need to change the roof of your house, change the AC? You need some money to be liquid and accessible pretty quickly. So once these buckets, our living expenses and the emergency, are covered, the rest of your assets, this is the fun part and the fun bucket, focusing on the targeted growth. So that could be either you want to grow your assets, you want to pass money on to the kids, pass money on to the charities, and we can invest more aggressively. So for example, stocks, mutual funds, ETFs. The idea is to get a better rate of return. And the issue, of course, is that we have full market exposure. So people tend to forget, but markets can go up and down. Pretty much for the basic retirement planning strategies, and of course, more in depth, there's different software that we use to know exactly how much you spend in retirement, how much you'll pay in taxes. But to make a quick introduction, that's how it works. Then jumping in the investments in the last section of this webinar today. So that's looking at the markets and how they work. So when it comes to investing, the first piece and first question to ask, and that's what I ask my clients in the introductory conversation I ask with them, is where do you stand as an investor? Meaning, how much risk are you willing to take? So it's usually on a scale of 1 to 10, 1 being fully conservative, I like to have my money under the mattress, and 10 being fully aggressive in the markets. Based on that, the portfolio can be designed. So the most conservative one would be preservation. So we focus on cash, bonds, any type of bond alternative, any investments that would be conservative. Then moderate and aggressive could be more focused on US stocks, non-US stocks, and what we consider other, that's also precious metals, which is conservative, but same thing. I mean, gold can go up and down, even if it's been a pretty good investment lately, gold in general. So then looking at the portfolio in itself, depending on where you save today, so as I mentioned, that could be a 401k, an IRA, a brokerage account. Typically, what I see for folks that are saving into a 401k, they are into what we call this default option inside of the 401k. Fidelity has a lot of them. For example, it's called a target date fund, and it has a year at the end of it. And this year is assuming the year that you will retire. So these funds are predetermined. What they do is that they adjust the portfolio as you age. So assuming you're really young today, this portfolio is going to be very aggressive. If you're close to retirement, for example, 2035, this portfolio is moderate conservative, I would say. We have 6% of cash. Bonds, we have about 30%. So this is a 65-35 portfolio. So I would say moderate aggressive. The issue is that we don't necessarily are targeted with the returns that we get. For example, bonds in a high interest rate environment, you can actually lose money inside of mutual funds of bonds. US stocks, non-US stocks, we'll touch upon that, but there are some traps to avoid, because if we look at, for example, the portfolio returns for the specific target date 2035, over the last 10 years, the benchmark, that's the S&P 500, so the US markets. US markets have been doing pretty well, close to 13%. This portfolio has been averaging less than 8. So that's a 5% annual return that have been missed out if, for example, that specific client wanted to be fully aggressive. So 5% losing each and every single year, depending on the size of your portfolio, that's a lot of money. So Mostly, as I mentioned, it's because they are not necessarily targeted inside of the 401k. One of the reason is this non-US stock piece. So as I mentioned, I'm from France, so I invest in a lot of foreign companies, and there's some great French companies like LVMH. Dassault has been doing really good this year also. But inside of 401ks or generic options, what you have is usually this purple line. So this is the international world index, except the US. So that's the purple line. And in gray, you have the S&P 500. So historically, inside of this default option or any type of generic funds, they include diversification and international funds because historically it's coming from a theory in finance. It's called the modern portfolio theory. It was invented in the 50s, and mostly it was saying that the US markets were going up and down. International actually had an inverse relationship. So when the US was going down, it was going up, so investing in the middle, pretty much making money. But something completely changed that trend at the end of the 90s and early 2000. And this is the creation of internet and the fact that we have more globalized markets right now. So as you can see, the S&P is in gray, world index is in purple. In terms of diversification, we don't really have it, meaning when the US go up, at the end of the 90s, international go up, but not as much. And when we go down in the US, so for example, 08, a crisis that started in the US, we go down 57% over that 3-year span. International went down even more, about 62%. And really the biggest difference is that since 08 or 09, for example, if you're investing with me $100,000 in 08, 15 years later, we look at it and you would have had 200,000. So not too bad. But if we look at, if we were investing over the same time period into the S&P, you would have had 800,000. So at that point, you probably fire me, I understand. But the idea is that diversification, we can have it for different sectors. But overall, if it's a generic world index, it tends to underperform. So that's the lesson around the investments. Then in terms of equity style, we can also play with different type of sectors. For example, the sectors currently under Trump that are doing really well are called value. It's any type of healthcare, energy, financials, and consumer staples. These 3 different sectors have all been positive for the year versus what we call the growth sector. So anything around communications, semiconductors. So for example, companies like Apple, Nvidia, Google have been taking some heavy losses, or even Tesla this year. So playing with the equity style of a stock of a sector is also key in terms of the investment strategy. So the point is to be balanced and based on your risk tolerance. But that's pretty much all I wanted to cover today. Then this is more detail about the bonds, but any questions, guys?
Thank you, Sebastian. Don't hesitate to ask any questions in the chat. And I was going to come back to that question. Enzo asked it earlier. What is the best investment in 2025? And I guess that can lead to an under question where it's long term, short term, more risky, less risky. I'll let you answer, Sebastian.
So that really depends how of your age, first of all. If we're looking to make money right now, or if we're looking to make money long term, usually, I think I do have some information about it, but that's what I was mentioning around the value versus growth. So as I mentioned, value is historically, we don't get necessarily good returns with it. And growth is usually tend to overperform. So any type of semiconductors or NVIDIA, there's a lot of investments that are made in the US around data centers, for example, digital infrastructure. You will see some good returns. But in the meantime, in the short period of time, like for example right now, there's a lot of discussion around Trump's tariffs. So any type of long-term investments has not been doing too well, as you see for large cap. So large cap companies, that's a sector that's down 7.7%. Tesla is into one of those. Large cap value in the meantime has been up about 1.6. So just between these two, that's a swing of 9%. And as I mentioned, any type around value that's more defensive, what we call, you have different ETFs that have been performing well. The one that tracks the energy is called XLE. That's the ticker that has been doing well. One around the financial, JP Morgan has been doing really well this year. XLF is a good one. So I would say within the short term, so 3 to 6 months, I recommend my clients to be heavy in value or even peeling off some risk once we know exactly the extent of Trump's policies and what tariffs are actually in place, because it seems like it's more a negotiating tactic for now. That's mostly, if you want to stay aggressive, that's what I recommend. Otherwise, you can use cash, bonds for the conservative piece, but cash historically you get 2% returns, and bonds fluctuate, but yeah, we're not getting 5 or 10% returns with bonds. Not sure if that answers the question.
And you can let us know in the chat. I'm not sure if there is any other question right now. Now would be the time, guys. Next question is actually, I've heard of LLCs being filed as S corporations. How does that play into the optimization of tax liabilities? And I know you've touched on that already, but yeah.
Yeah, so mostly it's a change in just the way you file your taxes, but the biggest let me come back to it. Biggest advantage is around where is it? Is around the salaries that you pay yourself and limiting the self-employment and payroll taxes. So not everybody can file for an S corp though, depending on your residency status, for example. But yeah, but those are pretty massive savings that you can have, and it's just structuring the LLC is the exact same thing. Just looking at the S corp, it's more for when you file your taxes at the end of the day. But if you make sure to pay yourself a salary, you can save, yeah, in that specific example, about 15,000 a year.
Thank you, Sebastien.
But yeah, if you want more information about it and more like disgusting for business owners, you can scan that QR code, and that's a link to my calendar. So I think it works. So feel free to book a meeting. I tend to be make myself pretty available if I can. And we can also do meetings in French or in Spanish if there's any Spanish speakers too. But any other questions?
Now would be the time, guys. And I take also this moment to remind everyone that the replay will be available on YouTube probably today or tomorrow. So for all of you who want to rewatch it, or if you missed at the beginning, you can come back to it, guys. Don't worry. All right, I don't see any other question. I'm not sure if Betty wants to say a word.
Yes, thank you. That's very interesting, Sebastien. Thank you so much. That's why it's always good to have a financial advisor if you don't know anything, if you don't know where to go, because everybody is different. That's how I understand.
Yeah,
And if you
every
want
situation is
also to
different, and
open,
markets are crazy right now. So that's
yeah,
a
and
good time.
then wait and
Yeah.
see, sometimes they say,
I know.
but Sebastien will be the best to tell you what to do. And I think this is a great presentation because I understand it. So, and you know,
Thank you, Betty.
it's really nice. So you speak French, English, and Spanish,
Yes.
so everybody knows that's good. And well, thank you so much. if you want, you can look on our website and our YouTube channel and just take a picture also of his information so you can make an appointment with Sebastien. And especially for the people who arrive here, business owners who open their business, it's always good to have something on the side. You never know.
Thank you again, everyone.
Thank you, guys.